Selling business owners always want to be paid in full at closing for their business, but that rarely happens. Buyers will structure deals to defer some portion of the purchase price for two reasons. The first reason is that buyers want the seller to have a financial interest in the company's success for as long as possible. The second reason is that deferring some of the purchase price simply makes it easier for the buyer to finance the deal. The most common way to address those buyer issues is through seller's notes. A seller's note is where the seller acts as the bank for a portion of the purchase price. Seller notes often make up between 5 and 30% of a total deal value, and terms range from 4 to 8 years. Interest rates may be slightly below or above market rates. Seller's notes often come with special provisions to protect the buyer's cash flow in the first year or two after a sale. For example, a seller note might just accrue interest for the first year, with principal and interest payments beginning in year 2. Or the note might have a below-market interest rate for the first year or two, and then a higher interest rate in later years. Ideally, a seller's note is structured to provide the buyer with a financial incentive to refinance the note before the maturity date. For example, if market interest rates are at 7%, and the seller has taken a 6-year note, the interest rate on the loan might be 6% in the first year, 8% in year 2, and then 10% in year 3 and beyond. If the business is successful in paying down debt in the first 2 years, they'll have a financial incentive to refinance the seller's relatively expensive debt in year 3 and then pay off the note early. The key risk with seller's notes is that they're always subordinated to bank debt and they're rarely backed by collateral. When the buyer is an individual, it can be possible to get a personal guarantee on the note, but that's only worth anything if the buyer has significant personal assets. Seller notes are subject to very special restrictions if the Small Business Administration is backing the buyer's acquisition loan. The SBA allows the buyer to use a seller's note as part of their equity or down payment in a deal. In those situations, the note will be on what's called full standby, which means that no payments can be made to the seller until the SBA note is paid in full. Fortunately, full standby notes are generally limited to 5% of the total purchase price. Some SBA deals have two different seller notes, one that is on full standby like we just described, and the second note has fewer payment restrictions. The details of SBA rules are beyond the scope of this discussion. Just know that when the SBA is involved, any seller notes are subject to special SBA rules. Seller's notes are very common in small to mid-sized business sales. They do give sellers a reason to support the business in the years following a sale, and they reduce the buyer's financing burden. And while unsecured seller's notes do carry some risk, they're generally less risky and less susceptible to disputes than earnouts.